All right, I guess we can start right now. Good morning, guys. Thanks for tuning in to this week's 11:15 webinar. The Hong here from Research, and in this week's webinar, we are going to talk about BHG Retail REIT. We're going to do an IPO preview. So this is a new listing for SGX, the first for the SGX main board for the year. Trading is going to start on Friday. The application has already started last week. It's going to close in about 40 minutes time at noon. So we're going to do an analysis on the REIT, and then we will compare the REIT to the nearest peer on the SGX, CapitaLand Retail China Trust. So we'll jump right into what BHG Retail REIT is about. So BHG Retail REIT is actually, they have this strong sponsor. Those of you who are familiar with China's, who frequent China enough, you might have heard of Beijing Hualian Group. So that is their parent. And for the REIT itself, in the IPO portfolio, there will actually be 5 malls listed on your screen. You can see from the list. So the biggest contributor to 2016 NPI, forecasted NPI, you can see is actually the mall in Beijing. So they have 4 other malls in Hefei, Chengdu, Dalian, and Xining. You look at the table of the 5 malls. The last 2 are actually malls which are on master leases. First 3 are on multi-tenanted. So we look at the occupancy rates for the 5 malls. You see that they're all pretty close to 100. For Beijing Mall, you see that it's actually at 80.5, which looks worrying, but that has got to do with the cutoff date as to when they published the IPO prospectus. As of that point when they published is 80.5, and at that point they were actually in the midst of negotiations with some other tenants. So as of 31st October, management has reported that the occupancy rate is actually 98.1%. So you see that all 5 malls have pretty close to full occupancy. And that's usually the case, right? Because when they will IPO at the most opportune time, the most rosy time. So you can expect the malls to be all close to full occupancy. Remaining underlying land tenure is all around 30 years. This is not far off from what CRCT is doing. And the short tenure is actually not because of anything, but primarily because in China, land that is released for such commercial purposes, they are usually not of that long a tenure. It's unlike Singapore where you can have your shopping malls on 99 years. Then for most of the malls, I would say the operations are all pretty recent. Beijing started in 2010. Hefei and Chengdu started in 2013. The 2 master leases malls actually started in 2000. So Hefei and Chengdu were actually malls that were injected into the portfolio in 2013. And later we'll look at the financial statements. We see that in FY13 and FY14 there was actually a boost in the earnings, which is primarily contributed by these 2 malls that were injected in that FY. So we have looked at the occupancy rate as of current. Now we look at how the malls have been doing historically. So you see that from FY12 to current FY15, the malls are actually doing all pretty decent. You see, except for Chengdu in FY13 and FY14, where it's hovering close to 90%. That has got to be the time where it's actually just started operations, and there could be a bit of the tenant adjusting in that period, or tenants start to slowly move in. So you see that occupancy starts to ramp up after that. Now it's doing 98. And as for the other 4 malls, like mentioned for Beijing Mall as well, now it's pretty close to 100. So historically, all 5 malls are doing pretty alright. Then you look at the portfolio lease expiries across the years over the next 5 years. They are all pretty well spread out. Uh, you see like a huge chunk is for FY 2020 and beyond. That is actually due to the fact that you have Dalian Mall and Xining Mall having master leases. So these master leases are for long tenors, which are actually due for like 1% rental escalation every year. So these long leases actually push a huge chunk of the lease expiries to 2020 and beyond. As for the WALE of the portfolio, that's actually doing at 6.5 years. That is pretty much similar to what CRCT is doing as well. So for this offering, PHG REIT has actually managed to attract very prominent cornerstone investors. You look at the list, you can actually see China Life Insurance, and you can actually see this Thai individual as well, Dr. Chan Chai. He is actually the owner of the Red Bull brand. And for the enlarged capital, share capital, these cornerstone investors will actually own about 35% of the enlarged share capital. So if you have looked at interviews that the newspaper articles have done with the REIT CEO, primarily she mentioned three key points in which are the main selling points for the REIT. First, she said the IPO growth is going to come from the IPO pipeline, ROFO pipeline, right of first refusal, the pipeline of the 12 malls that the parent has. So the parent Beijing Hualien Group actually they operate malls. They operate malls in China. Some of them are owned, some of them are not owned. So out of the around 29 malls that they are running, around 12 are owned by the group itself. So for this REIT, the parent has actually put these 12 malls on this ROFO pipeline for this REIT, meaning to say if they were to sell it at any point in time, they will have to give it to the REIT first. And if the REIT says no, then then only can they consider selling it to outsiders. So that is point number one from her. But the thing to note about this pipeline is that for all 12 malls, none of them are actually ready for injection in the near term. Reasons quoted in the prospectus include like the the mall operator, they are still trying to stabilize the tenant mix, or they are still planning to carry out AEIs for the mall, or the third reason is some of the malls have not even commenced operations yet. So this first point about the growth from the IPO ROFO pipeline is not going to happen soon. At least earliest will be 2018. Then secondly, she mentioned about the Hefei Mall and the Chengdu Mall, which were acquired in FY13, still in stabilization mode. So as it ramps up the stabilizes the tenant mix, she expects these two malls drive to drive the organic growth going forward in the next couple of years. And then the next selling point she quoted was that they were able to attract all these cornerstone investors, these prominent cornerstone investors who are going to take up 35% of the enlarged share capital. So post listing, what are they going to use the proceeds for? Mainly is for repayment of debt. So if you look at the table at the bottom of your screen, about 500 million is going to be used for repayment of debt. So main usage of the proceeds will be for this purpose. So we look at the financial information for BHG REIT, and then we do a peer comparison. So if you look at this forecast period, which is what they have forecasted for November to December this year, because their IPO prospectus has given financial numbers up to August. So November, December should be the latest stabilized because along the way, they would have renegotiations for rental renewals. So your last 2 months of the year should be a fairer projection of what you're going to get, because they would have factored in all the new leases with the higher rents. So if you take the 2 months, the numbers, and you annualize it, you will be getting a yield of about 4% or 5.7%. So how this works is that actually there is going to be a strategic investor in the IPO, and that is going to be the parent. They're going to take up a 30% stake in the REIT. And as quoted by the CEO, this in a bid to demonstrate their support for the REIT, they are going to do a waiver to their rights to receive dividends from the REITs, from the REIT until 2020. So that is why you're going to see two yields here. The lower yield, which I think is a fairer representation, because this one is the yield without income support. Income support meaning the what the strategic investor has done to forego their rights to the distributions. But if they were to forego the distributions, meaning to say other unit holders will get more, then you will get a yield of 5.7%. So with the artificial propping up of the distributions, you get 5.7% in 2015, 6.3% next year. And the promise from the REIT is that they're going to pay out 100% for these 2 years at least, and thereafter at least 90%. But that being said, even with the income support from the strategic investor, you're only getting a 5.7% and a 6.3% for these 2 years. If you compare it with the Capital Land Retail China Trust, we have a buy call for this, and we have a target price of 190 for this. You look at the FY15 yield is 7.1% versus 5.7 for BHG REIT, with the waiver for the sponsor, the strategic investor. And then next year, 2016 yield, 7.4% for CRCT. This is not our house's projection, but this is a Bloomberg consensus. 7.4 versus 6.3 for BHG Retail REIT. So if you look at yield, similar story. They both own malls in China, exposed to a similar kind of geographic and playing on the same Chinese consumer story. You have the yield for CRCT being higher. Price to NAV is lower for CRCT as well. And if you do a comparison of the leverage for both, you see that the BHG is actually doing around 33.5 post IPO. CRCT is having around 30. And CRCT has a higher proportion of the debt hedged on fixed interest rate as well. 74% for CRCT and 52% for BHG. So we next compare the average cost of debt. For BHG is about 4.1 to 4.4 as quoted in the prospectus. For CRCT as of the latest quarterly reporting is 2.98%. And then CRCT has a strong sponsor backing as well from Capital Malls Asia, where they own the ROFO to the properties as well. So some other metrics that we compare for the two which are not in the table include the WALE, which I've mentioned before, is around 6.5 for both. And then if you look at all their leases, the leases with the turnover component, meaning to say on top of the base rent, on top of the fixed rent, the landlord actually gets a small percentage of your gross turnover for your tenants. So for CRCT, 85% of their leases do have this built-in turnover aspect, and for BHG, they have all their leases on with this turnover component. And next, we compare the NPM margins and the net margins for the two REITs. You see that from the property point of view, BHG REIT actually pales in comparison in terms of the margins that the properties can yield. Because if you look at NPM margins for for BHG, they're doing about 58, around this number. CRCT is doing about 65 NPM margin. And if you go down the rows below NPI, then you have all your like interest expense or your management fees, and then afterwards finally you get your net income. Your net margin for BHG also pales in comparison to CRCT. BHG is doing about 35 net income margin. CRCT is doing about 50. And one of the main reasons for this is that below the NPI line, you have the interest expense. That is usually the biggest expense and the biggest cost for REITs. Look at BHG's historical financial statements. Financial interest expense usually takes up about 20%, 20% of revenue because of the higher interest rate, like, as you can see from the table. But CRCT's interest expense as a percentage of revenue comes in at around 10%. So that is one of the reasons why BHG has a lower yield for distributions as well. So finally, we come to the indicative timetable for the REIT. It has already opened for application last week. It's going to close in a while. If you have not gotten it, you are not missing out on much. So for the same kind of exposure, we would actually prefer CapitaLand Retail China Trust. We have a buy call and a target price of 190 for it. Trading is going to start on Friday, 2 p.m. And if you just do a superficial valuation for BHG, we use CRCT's average yield for the post global financial crisis period from 2009 until present. The average yield of about 6.6%. If you apply that yield to BHG's projected DPU of 3.56 and 5.08 for these 2 years, you see that fair value should be actually doing around 54 cents or 77 cents. 77 cents is with the income support by the strategic investor. But without that support, if your DPU drops to 3.56, you're only getting a fair value of about 54 cents. So with that, we think that this IPO has an IPO price that is not compelling. We would advise if you still want to get exposure to this REIT, we would advise you to wait out for a better entry price. So with that, we've come to the end of our webinar, and we welcome questions from you.
Okay guys, if there are no questions, I would also like to point out that this morning's webinar will be our last for the year, and we will be back in January next year. So with that, have a great trading month ahead, great holidays ahead, and we will catch you guys again next year in January. Thank you. Huh? Hi guys. So if there are no more questions, we will end our webinar here today. Can you guys hear me? Hello, 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 hello. Hi guys, can you still hear me? Hello, can you guys still hear me?
Hi guys, can you hear me now? Hi, testing, 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 testing. Okay, great. I think we are going to end our webinar here because gotten, we've not gotten questions. So this we'd like to point out is going to be our last webinar for the year, and we will be back in January next year. So have a good trading month ahead, and we will see you in January. Thank you.